on May 20th. I'm Dillon Hakes. I'm joined by our Chief Investment Officer, David Allen. David, tough week for markets this week.
Yeah, hi Dillon. You're right. It's continuing the trend that we've seen over the last several weeks of negative week-over-week returns in the market. It's certainly been a difficult stretch.
This week we added not just a tough week, but it's also been a volatile week, a week that's been up and down. We started this week on a strong note. We had positive days on Monday and Tuesday. We had some big news that came out with some earnings releases for both Walmart and Target. It seemed like they stumbled a bit on their earnings. The market didn't like that, went right back to the selling mentality. What did we learn from the earnings releases?
You're right. So the Walmart and Target are obviously two of the biggest retailers in the country. And so how they go says a lot about how consumer spending is going. And what we saw in both cases is that, at least in the first quarter, demand held up pretty well. But the big change from what we had been expecting was that there was some pretty significant pressure on margins. So both are seeing reduce their outlook for margins moving forward, which is going to impact perhaps corporate profitability market-wide.
Another economic report we saw this week, industrial production came out. What did we learn from the report?
So in general, industrial production held in pretty well, particularly manufacturing, which grew month over month at twice the pace that was expected. Within manufacturing, there was really strong growth in auto manufacturing, which is a great sign in terms of greater auto manufacturing could lead to better new vehicle inventories here in the US, which should have a disinflationary impact moving over the rest of the year.
David, we've talked over the last few weeks that valuations in equity markets look attractive. Obviously, we're getting big earnings disappointments out of some large companies. Does this change the picture with what we see from a value standpoint?
No. So we continue to see forward valuations for the S&P 500 continue to decline. They're actually below the 10-year average right now. And on an earnings basis, we continue to see earnings estimates for the next 2 years revised higher for the broad index. So, I think these two reports are magnified because of the size of these companies and their importance in the overall retail market. But in general, I think the broad market continues to expect growth over the next 2 years, and valuations look fairly attractive.
David, switching gears a bit, looking at interest rates, we've seen them affect markets for the majority of the year. Lately, we see some stabilization. We've heard some stabilization in the Fed funds futures. What are we seeing on that side?
You're right. So Fed funds futures implied rates for February 2023 over the last few weeks have been pretty range bound between about 2.8% and 3%. We've seen markets trade out of that range briefly, but then pretty quickly fall back in. So that stability is good to see, and it should have a positive effect on equity markets.
Looking forward, we obviously are expecting the Fed funds or the Fed Reserve to raise the Fed funds rate. How do we expect that to affect actual interest rates, longer term interest rates?
Right. So if the market's expectation for the Fed funds rate, a little less than a year from now is somewhere between 2.8 and 3%, that's basically where the 10-year Treasury is trading right now. So it suggests that we're going to see some upward pressure on long-term interest rates, assuming the growth outlook holds up.
David, what does that mean for fixed income investors? Are we closer to the top? Is there a lot of damage left to be done on the long end of the curve?
From the perspective of a fixed income investor, it suggests that we're perhaps closer to the peak in interest rates than many people appreciate, and it may begin to make sense to take more duration in your fixed income portfolios.
So we mentioned interest rates have gone up significantly this year. People have paid attention. The housing market has also similarly been affected. We've seen 30-year mortgages jump over 5% from below 3% at the beginning of this year. How is that affecting the housing market?
So over the last week, we actually got quite a bit of housing data out, and pretty consistent through that data was signs that housing demand is slowing just a little bit. Still high from a historical perspective, but down from what we saw this time last year. Some of that might be due to workers returning to the office. There's less demand for additional space in homes, but I think interest rates explain most of the decline we're seeing.
All right, David, what do we have on the agenda for next week?
So for the next week, actually quite a bit of important economic data. Starting off with on Wednesday, we'll have meeting minutes from the last FOMC meeting. And then on Thursday, we'll get our second look at first quarter GDP. I think based on the strength that we saw in the March revisions to the retail sales report, there might be some potential upside there. And then on Friday, we'll get a look at April personal income and spending data along with PCE inflation. So that'll be a great look at both how the consumer is trending early in the second quarter, as well as how inflation is trending at this point in the rate hike cycle.
Thanks everybody for joining us for This Week in Review. We'll see everybody next week.